Hey, everybody, I'd like to welcome you to our very first Merchant Sales Podcast video episode. We, of course, have this episode on our audio channel as well. So if you prefer to jump over to, the podcast app in iTunes or Spotify or Stitcher or SoundCloud, we are there. But, for a long time, I've really wanted to get that extra interaction of the video version. So we are, this is a new one for us. We're testing it out. I hope that you really like it. Do me a favor. If you're watching this episode, watch the entire thing and then go ahead and hit the subscribe and even the notification bell if you don't mind. We only put videos out twice a week now. We have one where I do a sales tip during the week, and then we're going to have our podcast episode. And so if you want to get notified, make sure you subscribe and hit notify. And if you like this episode, do me a favor and click that thumbs up button right now. If you like it throughout the episode, hit that thumbs up button and make a comment, because I would love to hear from you about our new format with our podcast. Let me know if you're enjoying it. Let me know if you're liking it. And I hope that you're going to enjoy it immensely. So let's dive in. We had a great interview today, and let's go ahead and dive in and start up that interview with Kyle.
Welcome to the Merchant Sales Podcast.
All right, everybody, I'd like to welcome you to the Merchant Sales Podcast. And today I'm joined by Kyle. Kyle is the CEO and head of product for Mercantile Processing. How are you doing today, Kyle?
I'm doing great.
Awesome. So, first of all, I should, tell all of our listeners that we're doing this on video for the first time. So if you want to check it out on our YouTube channel, we do have the episode up there. So Kyle and I are going to talk today about really scaling up your ISO, whether you're an individual or small office. And we want to kind of dive into some practical tips for those that are looking to build out, really building that merchant services business, not just an individual. Before we get into that, though, Kyle, we'd love to get your backstory. So how did you get into this crazy industry? How did you end up at Mercantile?
Yeah. So started Mercantile just under 15 years ago.
Oh, wow.
I was a sophomore in college, reading a book about residual income and business as a start. Always an entrepreneur at heart. Used to sell glow sticks on 4th of July. Used to do all kinds of stuff to sell. So I was always, figuring that idea. So I found this, was an agent for a small company that we kind of found, sold about 7 or 8 deals. Was serving and bartending at night and selling during the day. Built up a small little book, and then eventually found the green sheet. So I love that Patty's on the line, but
oh yes.
And then actually found the ISO that we worked with for about 4 years after that. They were the centerfold of the green sheet back then, IRN Payments.
Oh yes, I remember them well.
Yeah. They've great company. They've since been bought by Shift 4, but that was my first agent relationship. About 2 years into running it, so what should have been my senior year of college, we actually got our first opportunity for a small community bank in the area, 9-branch bank. We started doing their work. We were bidding against the big guys. They liked us. I was 22 years old. I still remember that meeting, the stress levels of that, but we got our first bank. The next month we did 17 apps, hired my roommate from college, and we kind of grew from there. So that's the beginning of the industry. So, and then just have been staying in it ever since.
I have to say, I love all the stories that I hear from people, especially in this business, people who started off in college, as a side job, and then built a great portfolio. It just speaks to the obvious opportunities that this business creates.
Oh yeah.
Yeah, it's so true. It's it's really been interesting, Patty. I think a lot of the people that we've interviewed really fit that same.
Yes.
Got in, and some of them, did a little bit of a different path, Kyle. Some of them would, they got their first job maybe out of college at a credit card processor, and they thought it was this mindless drone job that they were going to get rid of in 6 months when they found a real job. And here it is 20 years later, and they have their own ISO or whatever it is. So,
and we've even had a few people who said, "Oh, the heck with college. I'm just going to keep doing this."
Yeah, exactly. So Kyle, I want to dive into this topic, and it's such an interesting one to me because as I've been having conversations with individual agents over the last, 8 weeks to 12 weeks during COVID-19, one of the things that's been super interesting to me is that many of them are taking this time to take that step back and, think about life and think about their business and what do I want to do with the next 3 to 5 years of my life. And what I'm sensing is a lot of individual agents and maybe small ISOs that have 1 or 2 employees, they're thinking about starting their own ISO and really kind of scaling up and doing that. And so I would love for you to kind of frame this topic for us a little bit and tell us, how do you view this decision? What are the things that they need to be thinking about when they're talking about scaling their business and taking it to the next level?
Yeah. So, so this is, they always talk about, there's always steps along the way, and you have the failures that you've made that make you kind of the business owner that you are today. About our 6th or so year in, we decided to take the leap that you're kind of talking about. These guys have all taken. You know what I mean? We
Right.
said, okay, let's borrow $250,000. I took my best sales guy and my operations person. We made them, directors of sales, and we were going to the trade shows and setting up booths and
Right.
trying to find agents and all that stuff. We hired extra support people. So, we took that leap of faith, and we did that for about 18 months before we quickly realized that, yeah, our app count was up. Yes, we were doing more, but we didn't have the funding and the size to really scale that to the level of what you have to do to make that work. So
Right.
we took some steps back. We a couple of mistakes there were, I took my best sales guy out of the field and I made him a director. Well,
Right.
that hurts app count. You know what I mean? I took my operations person out and made her a RM. So now who's running the shop every day? So
Right.
some of those things, when you're trying to make those decisions, you're going to go, okay, make sure first you're not cannibalizing, what your current situation is. So if you're the CEO and you're the main sales guy, and you're going to go on to hire 4 more people, well, 4 more people come with 4 more problems, employee handbooks, benefits, people going out sick, stuff like that. So take a really good look at what you're going to change to make your ISO grow, and how does that cannibalize what you're currently doing. I would also say, really look at your model. I would say the mistake was going the 1099 model for us, because we didn't really anticipate, said, yeah, we can increase our app count. But when you're giving 50, 75% away to an agent, and you have an employer paying to run that agent, you have to bring in, we'll say 75%, you have to bring in 4 apps of a 1099 rep to equal if you brought your own app in that was 100%
Right.
for
And that's not
yourself.
including the overhead. That's just
Right, exactly. That's
for
just
the
the
minimal loss.
the
Right.
sheer numbers. So when you kind of look at your model of going, okay, if I want to go the 1099 route, you've got to almost quadruple your app count to make the same amount of money you're making as a 1-man, 2-man shop.
Right.
And that's, do you really want to grow and get the headaches and do all that stuff just to make the same amount of money? So, if I had to go back and do it all over again, I would have grown the ISO, and we still continue to do it now, but we revamped our model. Pretty much everybody's an employee. We do have some 1099 contractors, even from back then, that are still with us. But we focused largely on, I call them the bigger guys. They've already got $100,000 or more in residuals.
Right.
They want a shop to put their deals with that are technology based or something like that. So that's how we've changed our model a little bit. But when you go in it as an ISO, or you try and go the ISO route, I think everybody in their head goes, well, I could do a better job than the ISO that I'm currently putting deals with. Everybody's just going
my
to
own.
make it so good. Yeah. So
Well, and I love this conversation, Kyle, because something I'm really passionate about in the industry that and it's my own fault as well, but that we just don't talk about enough. When you watch my videos or you go to the Green Sheet, there's this perception that there's these 2 types of entities. There is the individual agent, and then there is these humongous companies that have 200 employees and 1,000 agents. And it's like, which one of those do you want to be? And the truth is, there's a ton of room in the middle. You don't even have to have a 1099 person that you're associated with. You can grow with, like you mentioned, W-2 employee model. And I think there's a lot of that white space in the middle of figuring out how do you want to do that. One of the things I think is so interesting is this question of, first employee. You mentioned your friend from college. I've talked to so many salespeople. It's a really good example of one is a guy named Vic. I've actually interviewed him on the podcast before. Individual agent I've known for, 10 years, and built up very successful business. And he hired me as a consultant to figure out, okay, how do I get to the next level? And one of the things we did was we hired his first employee, and it's, I think she's 30 hours a week, and it's like just an administrative person, doing paperwork, and so to your point, I think a lot of people in this business, for some reason, they all naturally think in order to scale, it means it means bringing on 1099 contractors. Why? Like, yes, that's one option, but you realize you could also get an administrative person. You could also get an office manager. You could also get somebody to do your installs. So it's like, you don't have to cannibalize your own efforts and the efforts of your best people in order to scale. So I'd love to get your thoughts on that. And also kind of this idea of first employee, what have you seen play out successfully? Who do we hire as our first employee? What do we want to think about when we're making that decision as an individual agent?
So I totally agree with what you're saying is, I think everybody thinks scaling is increasing app count or increasing salespeople and all that. I would say that you're exactly right. I would say the first employee is obviously going to be the person that takes something off of your plate. If you see, I was able to do 15 apps a month when I first started, and then I started to have to do support, and, now I'm down to 10, and then now I'm down to 6 because 3 days of my week are spent servicing my existing customer base. And that's what we need to do. We need to service our clients, which means, you keep the residual income coming in. At some point, you look at the critical mass and go, okay, what's my opportunity cost? Can I have, can I have an assistant at, say, $15 an hour? Okay, so I'm gonna lose $30,000 a year, $40,000 a year to have this person, but can I bring in $20, $30, $40, $50,000 more in residual if I have them? The answer is no, then don't do it. You know what I mean?
Right,
but
right.
if the answer is yes, then it's a no-brainer. You're gonna take one step back, but in the next 2 years, you're gonna take 2 steps forward. So that's always kind of the math you have to do is what's the opportunity cost? Right. And are we growing just to grow, or are we growing to make more money?
Yeah. And it's like, I always tell, agents at this level that, you can either look like you have money or you can actually have money. You
have
It's very expensive to look like you have money. And so I think a lot of times there's maybe this pride and this arrogance of like, I want to be able to say I have a big company or whatever. And I fell prey to it myself. We had, when I started my first like real ISO, I had an employee team that was like amazing. I had like 3 people and I was just making money like crazy. The administrator, the person that did my installations for me, my customer service person, right? And I'm selling 28, 30 deals a month. And it's like, I'm keeping all the residuals and I'm paying, this is amazing. Well, then I'm like, well, I'm better than this. I can start a big company, And, you got to be careful what your motivation is, because I think to your point, there is that middle stage where you actually don't make very much money. You're losing money by scaling. Yep. Growing your business is not like, we're so much more profitable because we grew. If you really grew a lot the last year, you probably lost money.
Yep.
Mm-hmm. The more you grow, it's like super expensive. And so it's like, in my case, we were able to grow to 200 deals a month. Well, that's profitable. That's great. But going from 25 deals a month to 50 usually sucks. Like from a financial perspective, that's usually a really bad idea, actually.
Yeah.
So, all right. So let's shift gears a little bit. Kyle, talk to us about ISOs. So I've already got that team of 3 or 4 people. Maybe I've got 1 sub agent, an employee, an administrator, whatever. So now I want to scale up. So I want to get from, 20 to 30 deals a month. I want to get from there to, let's say, 70 or 80. What are the things I need to consider in making that move? What are some of your thoughts on like, what things should I take on? What things should I leave for the process? Or give us your thoughts on that transition.
Yeah. So, I mean, I'll talk from what I've seen, not necessarily from experience. We're about 13 employees. So, and we're doing that 45, 50 apps a month. So we're kind of at that level, and it's steady, and we have partners and stuff like that.
Right.
But, the ones I've seen who have done it successfully, and you talk about this a lot on your podcast, is be good at 1 or 2 things. Find a vertical, find a software, find something that really, you're just going to be really good at. You don't have to be the processor that does everything. Right. You need to be the processor that does something really good. And our most successful agents do that. One's in trash and has a trash software and is in that space, and he's doing great. We've done an integration for one that does bed and breakfasts in small hotels. So like those guys get steady apps every month. Right. And that's because that's what they're in, and they're getting referrals, recommendations, stuff like that. If you're out there going, well, I'm gonna put out a great bonus program, a free terminal program, and the apps are just gonna kind of roll in. It's like, yeah, but are those really the people you want to go? And I always tell my sales reps, if you sell on price, you're gonna lose the deal on price.
Right.
But if you sell on integrations, efficiency, those kinds of things, and that's also attached to, oh, by the way, your accounting software is recommending, that you as a processor. Right. Now you've got it. So,
right.
We've done really well on a scaling side where we do a lot of the banks in the area. So for us, banks is kind of our vertical.
Mhm.
We're the Maryland Bankers Association preferred provider. You know, I mean, so we do heavy in that space. But that's also still getting a little dangerous too, where, you know, we are getting probably about 60 to 70% of the banks, but these software companies are going in and going, hey, if you're going to use us as your software, you got to use XYZ processor as your processor, or you have two options.
Right.
So again, we're already seeing that even just being in the bank vertical is not strong enough anymore. You have to be attached to software integrations.
Sure. Yeah,
Sure.
I love that. I think that's so true. I think if you're involved in the payments industry today and you're not, you know, totally all in on software integration, I don't know what it is you're doing, but it's not going to work. Like, you know,
Yeah.
but
Yeah.
I love what you said. And Kyle, I think if I could even rephrase a little bit, the way I would say that is it's like, you know, who are you as an individual or as a brand? And it used to be okay to say, I'm a credit card processing sales professional. That's not enough anymore. You know,
Right.
people want more. They want to hear you say, I am a payments and integration expert for pizza shops. You know,
Mm-hmm.
like, right? Isn't it? Have you seen where it's like, you almost have to be that specific because to your point, if you want to get referrals, if you want to build your network, people need to know who you are, what you stand for, exactly what you do and what kind of value you can bring to the table. Otherwise, you know, you're just like everybody else.
Yeah,
Yeah.
agree.
Okay, so here's an interesting question for you. So we're talking about scaling, you know, talking about ISOs that maybe are in your kind of same, you know, size and a little bit below. And, you know, how big is too big? Is there, you know, is there kind of this point of no return where it's like, okay, if you're going to go past this point, you better go all the way. Otherwise, you know, you're not going to make very much money. And again, I can speak from experience on the other side of it where it's like doing the 200 deals a month. I mean, the amount of capital that we burned through,
Yeah.
you know, I
Mm-hmm.
mean, literally we were burning, I remember at one point we were burning about $60,000 a month that
Wow.
we were losing. Like that was our you know, at the end of the month, hey, here's our profit and loss report. You know, we lost 60 grand, we lost 100 grand. And I mean, that wasn't like a crazy number. It's just buying merchant accounts from 1099 agents is very expensive. It can play out in the big scale, but give us the idea of kind of from the other side of that. Where do you kind of see that point of like, you know, for an ISO, how big is too big, and how do you kind of make that decision of where to kind of be careful about the growth?
Yeah. So I was lucky enough. One of my other roommates in college was a math teacher, so we actually built an algorithm on, you know, what's an ROI on one of our W-2 sales reps.
Sure.
We've got it down to about 17 months before we break even on any deal. So what we pay them in commissions, what our overhead is, all that stuff. So as long as that sales rep is hitting their quota or going above their quota, we know in 17 months we're good. So the problem with that is now you have to go and go, okay, if I'm going to hire 2 more reps and I'm going to borrow against my residuals the borrowing companies do about 20% is their going rate right now for borrowing against your residuals. You have to kind of look that up. I'm going to borrow $500,000, hire, you know, I'm going to need that to hire 5 sales reps for 2 years.
Right.
What's my ROI if they all hit their commission and hit their quota versus my cost of funds?
Right.
And in 3 years, am I happy with what I'm making as the owner of a processor? Going, okay, I've done all this work, I put all this money in, I put all the risk up.
Right.
I'm hoping all 5 of these sales reps hit their numbers. If they don't, I still owe back that money at 20%. You know, so those are the kind of decisions you have to make. And in our space, because it is residual income, almost nobody you're going to hire is willing to work on residual income. They want some of it.
Right.
You don't have to get much, but they want some of it.
Right.
But they want a salary. They want
to make $50,000 a year.
Yeah, exactly. So you have to find a way to find that middle ground. So you're basically you're selling them the dream of what you've already figured out, which is residual income, but you only give them a piece of that dream because they still want to live. And then you just have to run that math out and go, how does that make sense? To talk about even the bigger side of things, kind of where we're at is, you know, we're very scared to get past that 15 employee mark. Once you get past that, there are all kinds of regulations in how you hire and rules about firing and stuff like that. So I think for us, we're looking at the next 3 to 5 years going, okay, we want to keep growing, but we don't want to get so much bigger that we get past that 15 employee mark.
Right.
So how do we stay at 15 employees and get more profitable? You know, so we're looking at it that way because that's our magic number. Because once you get past that, now you need to hire an HR professional. Now you need to hire a finance, you know, not just a billing person, but a CFO. Like
Right.
Now it has to scale appropriately. So that's kind of where our magic ceiling is right now. Not to say that won't change if the right opportunity comes along,
For sure.
but it's gotta be a golden parachute, not
Yeah.
a lot of unknown right now. So
Yeah. Well, and I think too, the other thing I hear you saying there is like, you have to map out these finances, so I don't know, like I always use, Microsoft Excel, and I'll create a spreadsheet where I've got, the next 36 months, and I've got my categories over to the left. And then, here's our total revenue, here's our total expenses, and, putting that together. I mean, that kind of stuff takes a while. I know for consulting clients, a lot of times I'll spend a half a day on something like that. But I think if you're not able to see those numbers, you're just flying blind, just because you're like, this sounds like a really good idea, we should scale up. Well, have you run the numbers on it? And I think, one of the other things I tell my people a lot is, now that we've grown and things like that with our company, it's like, whenever I'm looking at an opportunity, I want to know what's my best case scenario, what's my worst case scenario, and how else could I make that same amount of money? Yep. Like sometimes you get to 3 years and you're like, okay, that looks pretty good. I'm making an extra $25,000 a month. Great. Well, then you're like, okay, but could you go all by yourself with one assistant and also make the $25,000 a month? If you could, well, then why are you doing all of this again and taking all this extra risk? And so I think, I think that's actually super interesting. So, obviously each situation is unique, but for an agent or an ISO that has to choose a processing provider. So obviously you guys have had to make this decision. Do I go with Thesis, First Data, Elevon, Fiserv, whatever it is. What are your thoughts on that? How do ISOs and agents that specifically are looking to grow, they want to scale, what are those key decision points in your mind of finding the right company?
Yeah. So, for us, the decision was obviously, we have bank partners, so we needed a back end that was very high service oriented. So we did choose a processor that, they gave us a penny and a half less and a half basis point worse than the best offer. But at the end of the day, we knew if somebody from one of our merchants called that processor, we knew we would, one, see a note about it. So we'd be able to track that it was happening. And two, that they would get at least a 95% chance that they're going to have a good experience on that phone call. They're not getting routed somewhere wrong or being transferred 9 times or whatever. It's usually a one call solution, or at least a good handoff, not just let me transfer you back into the queue one more time. Right. So that was our big decision there. A couple other major ones I would say that, most people need to think about is, what type of business are you writing? I would say our back end currently now is very low risk tolerant. If they have a bad credit score, or they're doing a lot of card not present or a lot of future delivery, we're still offloading about 4 or 5% of our apps somewhere else, because just this processor is just not risk tolerant. So if you're doing all Modo, my processor that I'm using right now is not the one you'd want to choose. Right. So just understand, not only is it the best price, the best split, the best service, but are they going to take the deals you're going to get them?
Right.
And are they okay with that? Are they going to hold it? That's my biggest problem with some of these processors. They'll approve everything, but then you're stuck answering calls because they're holding transactions 2 months later.
Don't want to get that call.
Yeah, no. And so I would say those are the two biggest things. First for me is service. Second to me is, risk and underwriting. And then all the way down there at third is probably price. You know what I mean? I would say, yes, you want a good deal, but if you're going to squeeze an extra penny out of it, look at your numbers. Okay, right. 1 million pennies. That would mean extra $10,000. It's the same thing. If you had to take 10 risk phone calls a month, that $10,000 is already out the door, because now you're the one handling all those issues and not selling.
And you're losing.
Yeah, sure.
Right. So yeah, that's interesting. And so I think that even begs a larger question though, because there's so many other things today that you can, whether you look at a PayFac model or something, there's so many other things you could take on if you wanted to, whether it's risk, underwriting, even sending out the statements, you know what I mean? Like, what's your opinion on kind of that? There's so many of these processors now that'll say, hey, you can do as much or as little as you want. Where do you go along those lines? Are you thinking more like, let's let the processor do everything possible that they can do, so we focus on this? Or is it, we do want that control? Like, what are your thoughts on that side of it?
Yeah. I learned early in the industry, we had the first account that we saw a loss on, that not us, we don't take on any risk. Our agents don't take on any risk, but I saw my processor take on risk.
Right.
The first one was about 4 years into the business. It was an 100% swiped account. It was a bridal shop. They got to tax season, couldn't pay their tax bill, went out of business, and the
Ooh.
processor had to eat $16,000 in bridal dress deposits. You know what I mean? So again, you look at that deal, go, is it risky? Is it not? I would have said, no, it's not. That's not risky. It's all chip entered. It's all swiped. It's all whatever. But it still happens. So for me, I like to sleep at night, not knowing that there's not a merchant out there doing something that I can't, even if I was monitoring that account wouldn't have gotten flagged.
Right.
So,
Right.
you know, that's where I feel about the risk side of things. On the other stuff, I mean, like our names are on our statements. Most of these guys will white label your statements for you.
Right.
Our phone numbers on our statements now. I mean, most of the stuff that you can do, you know, we're about to take PCI in-house. There's a little bit of revenue bump for us, but again, we got to the size now where we want the control to help our customers. But again, that's a net neutral for us. What I have to pay an employee to do versus the extra money I'm making on PCI, it's net neutral, but I'm making that decision. So again, it's about what you want to have happen. And if it's about making a little bit more money, I would say don't do it. But if it's about, you know, like we're doing with PCI, it's about making sure that I don't get angry calls and have to keep refunding PCI fees every month.
Right.
Then that's the reason we're choosing to take that over, even if we make an extra $2 a month per PCI fee or whatever it is. You know, those are the decisions that we're making.
It sounds like it's a control issue too, right? Is that's what you're saying? Is the control has its own value?
Yeah.
Yeah, I like that. I think it's one of the big traps actually that a lot of smaller companies do fall into, you know, and like one of the things you were saying there that I think is interesting is, you know, you're at a scale where you have enough merchant accounts that at least it is a break even for you to take on PCI, right?
Yeah.
If I have 200 accounts, if I have 300 accounts, why on earth would I want to take on something that's going to make me an extra, you know, $800 a month? And it's going to take an employee, you know, an extra 10 hours a week to do it. Like, you know, so I think it's the, you know, just taking something on, you know, to your point, I think only take it on if you believe you can do it better. And if it's going to help you to differentiate yourself in the marketplace, not just like, oh, I just want to take this on. No, that's usually a really, really bad idea. So, and I think risk is, I'm always amazed when I talk to companies, and I talk to a lot that are, you know, they've got 1,000 merchant accounts, and they decided to take on risk to make the extra 3 basis points.
Yeah. And
I'm like, wow, I mean, that could play out really good for you for a year. But, you know, the first time you have 4 merchants in a row that you lose $60,000 on, all of a sudden that decision doesn't look very good anymore.
Yeah. Right. I think what they always tell us, I mean, I've asked about that a few times from different people. They're always talking about if you're looking to sell your ISO quickly, taking on risk is important. So if your goal at the end of it is to sell it,
yes,
you know, to own the paper, to own the underwriting, to own it end to end, so you can present your book of business and you can stand behind what it is to an acquiring bank that wants to buy it from you.
Right.
Then then they'll go in deep into that. But at that point, again, same thing. You would need an $80,000 to $100,000 a year risk manager just to do that piece. And then if you have a single loss or two, now what's the point? Unless again, your goal is in 3 years to sell off, or your goal is, you know, whatever your goals are, it kind of depends on what you want to do. Yeah.
Let me dig into one more real quick, and then we'll wrap it up. One more kind of side thought on this. I want to talk about capital for a second because you brought it up a couple times. Now, for me in this industry, I have always been a big believer in using other people's money, specifically the processor. So every time I've ever done a deal, and that's obviously I sold my last ISO 5 years ago, so I've been out of the game a little while on that front. But you know, when I was burning that 100,000 a month and, you know, and stuff, you know, that wasn't my money. I, you know, was borrowing that from the processing company at a very low interest rate because I was saying, hey, look, I'll be exclusive with you. I'll bring my deals to you, but I need a, you know, $2 million line of credit. So I can get past the burn rate. What are your thoughts on, you know, capital? Where did you guys get your capital to grow? Did you bootstrap it? Have you used other like processing companies? Do you have any kind of tips for people that say, well, yeah, I really do want to get to that next phase, but I need $500,000. Where do I get it? What are your thoughts on that?
Yeah. So, in the beginning, we had an angel investor. We had 50,000 in the very, very beginning. I had my first employee, a family friend. He came back again for the 250 that we did when we tried to go national. Once you get above that 100,000 mark, you start running out of friends who have that kind of cash laying around. So, you know, you go to the ones that are out there. We've used Super G about 3 times now. Yeah, Darren Ginsburg over there and Josh and all the guys. So they've been really good. They'll give some free legal advice too, which has always been nice. So they'll kind of like look at your current,
Right.
book and your contracts and go, okay, we're okay with this, but maybe you might want to renegotiate some of these terms because they make us nervous.
Right.
So they've been good. Now, it's how do I put it? It's still very expensive capital to get. You know what I mean?
Yeah.
So while they are a great company, they are taking on the risk that your current processor is not going to pull the rug out from underneath you, that you're not going to walk away from servicing your customers. So I don't blame them. That's a lot of risk for them to take on to give you cash only secured by essentially a portfolio or two.
Right.
So I think that's where that is. And again, it goes back to, if I'm going to take 100,000 and it costs me 20K a year to have that, I better be coming out of the other side of it making 200,000, because what's the point? You know what I mean? Because at the end of 3 years, Super G's made 60. I've paid back my 100. I better at least have made more than that. So when you look at that capital, look at that expensive side of that. As far as the processor side goes with the lending, I think there's a lot of good processors that do that well. And they lock you in as exclusivity. They'll do that kind of stuff. I think their model is definitely about showing growth to their investors.
Yes.
So they have VC money. Yeah. So if they're already out there buying portfolios, they're already out there buying ISOs.
Right.
So essentially what they're doing is they're probably looking at you going, okay, if I give James $500,000, I'm going to tell him like I own his ISO on the books. They don't own you, but they're going to book you as if they own you until that loan is paid off.
Yep.
So on a spreadsheet somewhere, James Shepard ISO looks like an asset, not
I'm
like
just a line on a spreadsheet for a big company.
Yeah.
Yeah.
Yep.
You're right. And it's interesting too, because I think, how do I put this? I think for a lot of ISOs that are smaller, what they don't seem to understand is that their lack of stress and their smooth sailing in life, they don't sufficiently value that.
Right.
Like they don't understand, if I'm going to go, now again, you can go to Super G, as you mentioned, and we would do that like in between deals, right? So like I have this processor funding my 100,000 a month I'm losing. I get it to where I'm not losing any money. We're just about break even, but we need a little bit to get to the next relationship. So let's go to Super G. They'll give you a loan against your portfolio. And then we get the next deal. But the thing they don't realize is, when you go to a processor and you like sell your soul to the processor for a $2 million line of credit, you will have to perform.
Yeah.
Right.
And if you don't, they will sue you and they will take everything that you have. Like they are going to make money one way or the other from you. And so I think it's like, the level of stress, like now in my business, no risk for me, no debt, positive cash flow, training and technology. Great. You know what I mean? The level of stress now with my business versus then is crazy different. I mean, when it's like I'm using somebody else's money and I've got to come through on that. So I think it's a huge decision to make. And I think it's, for some people, for me, my wife, Christina, will tell you, I love to wake up in the morning and be stressed. I love it. I'm like, let's go. I gotta climb this mountain here, good night. How are we going to do this? Some people don't like that, that's not their thing. And so I think that's an important consideration. So Kyle, I think we could talk to you for another hour, but we better wrap this one up. So, I'm sure people will want to connect with you, learn more about Mercantile. So where would you send people that want to learn more about you and what you guys do?
Yeah, so our website is MPI, it's Mary Paul Indigo Processing.com. We also have our point of sale division, which is MPIPOS.com. For us, the 1-800 numbers there. The sales team, which also has me on the email, is partnersupport@MPIprocessing.com. I'll go to me, my director of sales, any of us on the support side. So they're interested in working with us. Our niche for agents and people now are, like I said, the agents that need help with the integration side. So we usually become more of a technology arm, a little less of just an app place you want to put apps. So if they want help with talking tech or talking integration, those are the agents that we really want. So that's kind of the contact point. So
yeah, I like that. No, that's good. So I think what you're saying is the agents you're looking for are ones that maybe have a specific vertical or whatever it is, but they've got a technology need and they need to integrate and they want a partner that they can depend on to bring those integrations to happen. Yeah. Cool. Awesome. Kyle, thank you so much for your time today. Really appreciate it. Great information. I'm sure our audience is going to love it. So I really appreciate you taking the time.
Yeah,
Thank you.
thanks so much, Kyle.
This is the Insider's Report with Patti Murphy.
So, we've been spending a lot of time these last few months discussing the coronavirus pandemic and the impact on consumer spending. And this week, I want to hone in a little bit on the impact on how consumers choose to pay.
Okay.
And the information I'm about to present was drawn from recent presentations by Visa, MasterCard execs to analysts.
Okay.
So first up, Visa EVP Oliver Jenkins spoke to Barrett and Company recently. And the big news here is that declines in spending are slowing, but also that growing numbers of consumers are spending with debit cards, not credit cards.
Yeah, I saw this report actually. I'm really excited to talk about this. I didn't know you're doing this today, but I just saw a report about this. So yeah.
It was. I also noticed after I reviewed these transcripts, I think CNBC and Reuters and a few other people did some stuff on it.
Yeah.
It's really compelling. I mean, Visa credit card transactions were down 21% in May compared to May 2019, but they were up 9% from April. So,
Okay,
from April 2020, right?
Right.
And, and not surprisingly, much of the growth is tied to card not present transactions. In fact, e-commerce transactions grew 12% in April versus April 2019. But here's the really interesting thing. Debit card payments were up 12% in May compared to last May. And Jenkins said the changes in payment preferences are similar to those that Visa saw back in 2008 when we had the financial meltdown, and again in 2018 when the federal government shut down. But he thinks this trend is going to continue past the current pandemic as more people remain edgy over borrowing. He cited some internal Visa analysis that suggests $100 billion a year in transactions are going to shift to debit from credit.
Yeah, I saw that. I don't like. What do you think about that? I mean, just like high level, do you agree with that or not? I was like, it's hard for me to swallow. I don't know.
I'm kind of leaning towards it. I mean, I think it's a high number. I'm not sure if that number is precise, but I think we're going to see a lot more people, who just, I'm just not sure I want to.
Is it a function of a lack of available capital, like they've maxed out their credit cards and now they can't use it?
No, I think it's a function of people I know with myself and people that I know, right? We're just a little edgy about, I don't want to build up my balances right now because I'll be honest, I'm one of those people that doesn't pay off my balances every month.
Sure.
Okay. And I think there's a lot of people like me.
Oh, for sure. Yeah.
For sure. Right. And so, in the last few years, I've been making a concerted effort to get all of my balances down to zero.
Right.
And now I'm in that place where like I have a balance on one card, the others are zero, and I just want to keep it that way.
Right. Yeah,
you
got it down to that level. Well, and is it like a fear of like what's driving this? Is it a fear?
I think it's a fear.
The pandemic. Like, what if there's a resurgence and the economy shuts down again? Is that
exactly? And in fact, I just had this conversation with two of my friends and another colleague recently, where they all said, "Look, we don't know when if this is gonna crop up again."
Sure.
We have a big election coming. Whenever there's a change in administration, things get a little bit iffy, right?
Right.
And if there's not a change in administration, I mean, it doesn't matter. I mean, there's so many, everything is up in the air right now, and people are just concerned. Like, okay, I have my job right now, but what if this thing really blows up and I'm stuck? I want to keep those credit card balances near zero so that if I have to use my credit because I've lost my job, I have it
available.
And I think that's what the thing is.
Yeah.
And I also think that you're seeing, this also goes to the contactless thing, right? Because contactless tends to be debit transactions because they're small dollar transactions. Okay. So, I think that, and it's also, he describes, what's his name? Jenkins.
Yeah.
He describes it as a pragmatic trend. Because he also says that more consumers are opting for cards with low or no annual fees and cashback rewards instead of travel rewards.
Well, that makes sense, obviously, because you can't,
Right? You can't travel.
you do with your
And,
rewards right now.
and I'll be honest, the one card that I have a balance on right now is my Discover because I get cashback rewards. And they're like,
Sure.
you know, I go on to Amazon. Hey, you want to use your cashback balance? You know, so I think that's interesting.
It's an interesting trend. It's like the two things I see with that would be, number one, I want to go on record as saying I don't think that's going to happen. So, you know, I could be wrong, but I'll be interested.
Yeah.
I really feel like, you know, 90 days from right now, I think when we get into the fall, I think when we get into the Thanksgiving and the holiday shopping period, I don't think you're going to see a huge difference in the percentage of debit versus last year. So I disagree with this guy, but I could definitely be wrong. He's obviously a lot smarter than I am at Visa there. But
Yeah, and they have all those analysts doing all the number crunching.
yeah,
So
he's got an army behind him, but I still think he's wrong. But yeah.
And I do think that, you know, you could see something between, you know, during that whole Thanksgiving to Christmas rush.
Right.
But then people
are going to finally be like, you know what, we're good. Let's go.
Let's go. I want to spend some money. But, you know, I think you're also going to see, you know, people going, okay, well, I really think it all depends on what happens with this pandemic, James. You know?
I agree. There's so many variables. Nobody could make a really like rock solid prediction of anything
right
now.
But I do think, you know, you're going to see, definitely seeing, you know, he noted, for example, you know, both Jenkin and Craig Vosberg, who was from MasterCard, speaking to some analysts at, I think it was, what does it matter? Oh, MoffettNathanson. That's who we spoke to.
Okay.
Both of them, you know, spoke to something you and I have discussed before, and that's the huge increase in contactless payments.
Sure.
You know, Jenkin put it a significant displacement transaction lift that we've seen in other markets, and now it's building steam here in the U.S.
Sure.
Vosberg said that, again, you know, speaking to the uptick in contactless, he said, I believe that even more today, and that will get to ubiquity sooner because of the circumstances around the COVID thing.
Oh yeah, 100% agree with that.
Yeah. And I also thought here was another interesting thing that came out of both Visa and MasterCard. And again, it goes to some of the stuff that you and I have spoken to. You know, we see a lot of trends, particularly with the restaurant sector, with online ordering, curbside pickup. Mm-hmm. And that's going to stick around.
Oh my. Yeah. Well, it's really interesting. I was looking at, I think it's called Darden, the company owns Olive Garden and Red Lobster and Longhorn Steakhouse. And I actually own some stock in them, so full disclosure. But I really like their company because, you know, I feel like through all of this, you know, their revenues have been way down. But the fact is they are, you know, they have implemented really awesome delivery and pickup services that I think are going to continue past. And I think they're actually going to come out of this where people are still going to want to go eat at Olive Garden. But I think people are also going to want to, you know, they're going to want delivery. They're going to want pickup. They're going to want all of that because we've gotten used to it. I love it. You know, I'm all about it.
Yeah. I thought it was really interesting. I ride by a Red Lobster a lot, and I have to admit, that's one of the places I like to go to. Yeah. And it was always in the past, they had one little space for curbside pickup.
Yeah.
Now they have 6 spaces.
You know.
Right. So, and I think it sort of goes to that contactless at all. It's not only contactless payments, it's contactless interactions. Right. And people see, wow, this is really convenient. This works really nicely. Yeah. I'm gonna keep on doing this.
Yeah.
So yeah, it'll be interesting to see what happens. Right. You know, I'm gonna, you know, I always like to sort of take the opposite of you, so you know, to kind of keep things interesting. So I'm gonna go with debit's going to continue rising, and let's see what happens.
Yeah, let's see it. I really want to let's get an update, and you know, let's do a 3-month update or something. And see
for sure.
Be very interesting to see. So awesome stuff, Patti. As always, thanks for sharing with us.
Sure thing. Okay, I think we have enough time for you to do yours, James.
Yes, we do. Let me pull it up real quick here. Hold on. 1 second here. Did you happen to look at the one that I had sent over, the questions from the field with the EMV chargeback stuff?
I didn't take a look at that yet. I saw I'd come over, but...
Yeah, we'll just wing it. So here we go.
I'm going to pull it up while you're talking, though.
Okay, cool. Well, I'm about to read it. So,
okay.
Awesome. Hey, everybody. So today in the questions from the field, I got a great question from Danny. And it was really an interesting one. And I wanted to do this with Patti because I thought she might have some insights as well. So it says, what is the interchange difference between dipping a card versus swiping a card with a chip on a POS? That's the first part of the question. Now, Patti, to my knowledge, there is no difference in interchange between.
That's my understanding too. Yes.
Okay, that's what I thought. And so I think where the difference is more on the risk side of it.
Mm-hmm.
Which here's the second part of the question: does the merchant lose their chargeback protection if swiping versus dipping an EMV card?
Okay, so he's saying if you swipe the card versus dip the card, and the transaction is charged back, there's a chargeback.
Right.
Does the merchant eat the loss?
Where, in my understanding, and then, maybe you can correct me or add some to this, but my understanding is there's different types of chargebacks. So
Right.
if we have a chargeback where somebody says, I never purchased that,
Mm-hmm.
if they're saying it's fraud related, then I believe that's where it makes a difference, right? Like
Yes.
if you, because if a fraudster comes in and uses a card that is EMV capable, and if the
Right.
merchant had an EMV terminal, it would have picked that up and said, no, you got to insert it.
Right.
But because they weren't EMV set up, they did the swipe transaction that should have been EMV and then fraud related. Then I think the merchant has a loss in that situation. Is that
Correct.
right?
That's the way I understand it. Yes.
And then that's it. That's really the only difference, because if it's a chargeback where somebody just says, hey, this
was defective or whatever. Right.
Then this doesn't really come into play. Then it's still a matter of just, it has nothing to do with the payment type at all. It's just a matter of they bought something and they're claiming that they didn't get what they paid for.
Right. But the way those, as I understand it, the way that the liability shift works, because this is what it was talking about, was the liability shift.
Yes.
Is that if it's fraudulent, the merchant has to eat the loss.
Got it. Okay. Yeah. So here's the third part of his question on this. So if we set the merchant up as an e-commerce card not present versus card present, my understanding is if the POS doesn't process a chip card using an EMV device, the card interchange is automatically downgraded. I think this is also true if we set the merchant up as an e-commerce account. The interchange is higher, but they do not keep. But do they keep the card not present chargeback protection? So here's the situation. We'll do the same thing, Patti. I'll say what I think and let me know.
Yeah, sure.
So my understanding is when we're talking about e-commerce at this point, EMV has really no impact whatsoever because
none. Right.
Because you can't do it. It's chip. And so
right.
With e-commerce, whether it's, the EMV has no bearing whatsoever. So obviously the interchange is going to be a little different because it's not card present, it's card not present, which has different, slightly higher interchange rates. But as far as EMV and chargebacks and fraud protection, EMV has no bearing on that whatsoever because it's e-commerce.
Right. But the e-commerce merchant does have tools that they can use to protect against fraud.
Sure.
I just the other day I was doing a telephone order, right? And I was really curious because I gave them my card number, I gave them my expiration date, and they're like, okay, now what's your CVV code? And I was like, oh, good. I'm glad, because
you're making sure it's really me.
You're making sure it's really me. And so those are the kind of things when you set up an e-commerce merchant, if you want them to protect against, it's a very simple thing, right. Even on online. Yeah. I think it's Google. I have Google set up. So if I buy something online, right, and Google will be like, hey, do you want to use this card, Patti? And I say yes, and they're like, okay, well, what's your CVV? And once I put in my CVV, Google fills everything else out for me.
Yeah.
And, those kinds of things, as a consumer, that makes me feel secure. Right. And I think as a merchant, it would make them feel a lot more secure.
Yeah.
Because that's the problem with EMV is that's why so much of the fraud shifted to the e-commerce channel.
Right, because of EMV.
Right, because of EMV.
Yeah, it's harder to do fraud in person, so now they're doing it online. Just stealing cardholder information. They don't even need the physical card.
Right.
And there's no EMV. And so, yeah, I agree. I think the only other part to that question that just to clarify, nothing about what we just talked about has anything to do with a downgrade. In other words,
Right.
from an interchange perspective, the EMV conversation has to do with risk and fraud protection. It has nothing to do with interchange.
Right.
So,
Right.
again, card present versus card not present, there are different interchange categories there. But as far as a transaction being downgraded, it's not like if you swipe an EMV card that it's going to be at a downgrade interchange rate. It has
No,
nothing to do with that.
has nothing to do with that.
Cool. Awesome. Well, there we
Great
go.
question,
So, yeah, great question. I really appreciate it. If you have a question, feel free to email me, james@ccsalespro.com. I can't promise that I'll email you back or call you back, but either somebody from my team will follow up and or we'll just feature it on a show and like this one, and we'll answer your question. So if you got a question, send it over to me. I'd love to answer it.
Great. Thanks, James.
Thank you, Patty.
And now, here is questions from the field with James Shepard.
All right, in today's question from the field, I got a phone call. I just finished having a conversation with an agent, and we were talking about this problem where they represent a particular processing company, a very large, one of the big companies, and there was another rep who represents the same company who kind of came through their area and gave that processor a bad rap, a bad, reputation. And so now this rep is struggling with, okay, what do I do? How do I overcome this problem? And so I was talking about, the way you present yourself, and this is so crucial. One of the things you have to understand, there's really two different types of organizations in this industry you can sell for, and you really need to understand which one of them you're selling for. The first type of organization you can sell for is the company that has a very public brand, and they're very concerned about making sure that their brand is, sterling, and that they're dealing with any issues that are coming up. A lot of times these are your smaller ISOs. They really stand for something. And in those situations, you can represent yourself as, hey, I'm with XYZ company. And, as you're just part of the company. Now, the other type of organization are these processors and even often acquirers that are very large. And you have to understand that their purpose is that they're not really a direct to merchant brand. Now, they may have certain divisions that are direct to merchant. Maybe they're ISV integrations or things like that. But as far as their traditional mom and pop shops that you might be selling, they don't really have a merchant facing brand per se. It's not like they're out there constantly trying to get their brand in front of merchants. Instead, their main function is to enable 1099 contractor agents to sell credit card processing services however they see fit. So that means if the individual wants to price the merchant really high, they let them price the merchant really high. If they want to price the merchant low, they let them price the merchant low. They aren't exercising a ton of control. And so when you find yourself in that situation where maybe you're selling for one or more of these larger companies that are just enabling you to sell, they're trying to give you the ability to sell, but they're not really controlling the way you sell. Then you have to be careful how you present yourself. Make sure when you go in, you're not going in with, hey, I don't go in and say, hey, my name is James Shepard with XYZ company, right? Instead, I go in and say, hey, my name is James Shepard. I'm a payments broker, and I work with different payment processing companies to find the best deals and the best technology for my clients. And so I like to present myself that way. And then what would happen is, if let's say I presented an app to them that was from, a company, let's say First Data, since they're like the biggest one out there. So, I present something from First Data, and they're like, oh, I hate First Data. I got ripped off by them and all this stuff. Understand it's not that First Data is evil. It's that there was an agent or an ISO that was selling for First Data that was dishonest or lacked integrity and did things they shouldn't have done. And so you have to explain that to the merchant. Don't be afraid to tell the merchant and say, let me explain how this works. Yes, First Data is one of the companies I offer, but understand First Data is literally just a provider for companies like mine. And I have several of these companies like this that are providers for me. So the good thing is we have a lot of different options. The bad thing is you have to understand that I'm offering you a really good deal. I'm offering you really good service. I'm offering you really good support. But understand that First Data is not controlling that. And so you could have very easily had somebody several years ago from First Data that they're not from First Data. They're just offering First Data services just like I am. But what they're providing is high prices, poor service, poor support. right? Low integrity. And that's a problem. And so, just understand, Mr. Merchant, that that's how the infrastructure of our industry works. It's not about the name of the brand behind it. What matters is the company you're actually dealing with, which in this case is me. So be careful how you present stuff. I think that you'll find this tip will help you. Again, if you're, just understand, think about the level of control. How much is the brand that you represent? How much do they control your actions and your pricing? I'm not saying they should control it. I'm just saying you need to be aware of the level of control they're exercising over their brand. If they control their brand pretty tightly, if they're making sure that people are getting a great deal, good. Then say, hey, I'm James Shepard with XYZ Processing Company. But if they're not exercising that control, and if it's possible that there's a lot of negative reviews online and there's a lot of other agents that are being disreputable and doing the wrong thing, that doesn't mean that that's an evil company. What it means is that company is just enabling resellers to do whatever they want. And so you're doing good things, other people are doing bad things, but you've got to present yourself as like a payments broker and explain how the industry really works, to those people. So, hey, thanks so much for taking time to join us in this episode. I really appreciate it. I hope that you enjoyed this, our first video here on YouTube of our podcast. We're going to do our best to put these out every week now so that you can watch the episode. I think you get a little bit more out of it when you see the interactions and the facial expressions and things like that. And so it's been a goal of mine to get this on YouTube. We've got it up now and we're going to keep it there. So we're really excited. Thanks again for joining us. Hope you have a terrific day.
Thank you for listening to the Merchant Sales Podcast. Whether you are an industry veteran, processing executive, or just trying to learn about the payment space, we appreciate your time. The Merchant Sales Podcast is a joint production of Greensheet.com and ccsalespro.com, and we hope you will tune in next week for more information and tips on building your merchant services business.